Hello, everyone, and thank you for attending today's webinar. This is Steve Gorin. My webinar is based on my third quarter newsletter, and the three topics this time are Code Section 199A, Safe Harbor for Rental Real Estate, then partnership structural issues, and let's go on to the next slide, and another one after that, and the sale of intangible assets. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We will try to answer these questions during the webcast, but if a fuller answer is needed or we run out of time, we will answer them later via email. A copy of today's slide deck is available in the resource widget. You can also find the PowerPoint for today's webinar along with my newsletter on our website, www.thompsoncobra.com. We encourage you to download any resources or links that you may find useful. You can find additional answers to some common technical issues located in the Help widget at the bottom of your screen. And I feel like I'm part of a widget manufacturer, like an economics school. So this webinar is CLE accredited in California and Illinois for 1.5 hours of general CLE credit, and Missouri for 1.8 hours of general CLE credit. We award CLE based on attendance for the entire 90 minutes. From time to time, you will be required to click a pop-up screen to reflect your continued engagement. We value your opinions and appreciate your participation in the course, and I also appreciate the participation of the American Academy of Attorney CPAs, where people are in a different conference room in my office, and they're listening in, and I'm going to go and talk to them after we're done with the presentation. So let's start diving in on the next slide. So the rental real estate and Code Section 199A. Of course, just a brief reminder, Code Section 199A is the 20% deduction for qualified business income that came in with 2017 tax reform. And we've had several webinars on this already, and so I'm not going to go into a lot of details on 199A, but the bottom line is that you need to have qualified business income, and so the question is, when real estate qualifies for a trade or business. So we will discuss the new safe harbor for real estate. There was promulgated with the final regulations was an announcement that the IRS was going to, a notice the IRS was going to put out a revenue procedure, and they had to propose a revenue procedure. And that proposed revenue procedure is out, and that's what prompted me revisiting this issue. So we're going to talk about the safe harbor, which really isn't that safe, and then we will talk about when you don't qualify for the safe harbor, which is almost always, how you can qualify for the deduction anyway. So going on to the next slide. So before we get to the safe harbor. There sometimes don't even need to look for the safe harbor. So rental is deemed to be a trade or business if it is rented or licensed to a trade or business which is commonly controlled. And you can see the definition of commonly controlled. I've gone over in prior webinars and it's in the materials. I'm not going to go over it now. But one thing just to emphasize again, rental to a C corporation does not qualify for the safe harbor because the rental needs to be eligible to be aggregated with the business that it's supporting, and it doesn't have to be actually aggregated, but needs to be eligible to be aggregated. And a C corporation cannot be aggregated. So rental to a C corporation does not qualify. So just for those of you who are thinking about choice of entity, we know that we always want to keep rental real estate in an LLC or some other type of entity taxed as a partnership, and we don't want it ever to be inside of our corporation. And so when those people who are thinking about converting to C Corp, one of the disadvantages of converting to a C Corp is it can throw you out of the safe harbor for qualifying the rental as a trade or business. Now also, if you do have a specified service, trade, or business, so those are basically service types of businesses, leasing, financing. We've gone over that again in prior webinars. And if you remember, engineering and architect were listed in there originally, but they got taken out. So they will qualify as a business, and that's because they are good and the rest of us are evil. So if you have a trader business and that's an SSTB, a specified service trader business, so you have an evil business, and the real estate is leased to a commonly controlled evil business, then the real estate is also evil, but only if and to the extent it's leased to that evil business. So you would look at the gross receipts and related deductions that go along with that, and so what portion of the gross receipts and related deductions come from the rental to the evil business, and only that part gets knocked out and is treated as a specified service trader business. So, of course, if your taxable income is below the threshold, then you are able to take the deduction anyway, but if it's above the threshold, then you will lose part or all of that deduction. So let's go on to the next slide. So the preamble to the final regulations gave us various factors, and now those factors are kind of only indirectly coming into play when we look at the safe harbor. So we need to, so you can just kind of look at those really quickly, and then I'm going to go on to the next slide. Okay, so Revenue Procedure 2019-38 provides a safe harbor under which a rental real estate enterprise, which we will be defining, will be treated as a trader business solely for the purpose of the 20% deduction. And if the enterprise doesn't satisfy the requirements of the safe harbor, as I said, very few will, then it may be treated as a business if it otherwise meets the definition of a business. So going on to the next slide. So the safe harbor, again, is with respect to the rental real estate enterprise, so you have to find a rental real estate enterprise. And if the safe harbor requirements are met, then the rental real estate enterprise will be treated as a single trade or business when applying the regulations, including the aggregation rules. So what does that mean? So all of the qualified business income, W-2 wages, and unadjusted basis immediately after acquisition, UBIA, all of those are going to be combined from all of the real estate that's lumped within this rental real estate enterprise. And then when you go to try to aggregate to see whether you can combine the QBI, W-2, and UBIA with other businesses, then you have to look to see how the whole enterprise is tied together with those other businesses. So you're going to look at the various commonality tests. There was a three-part aggregation test. You have to satisfy two of the parts. And so you would look at all of the rental real estate enterprise as a whole and run it through those three tests. Okay, next slide. Okay, I kind of duplicated this a little bit. Just wanted to mention on the third bullet point there. So remember, a relevant pass-through entity, or RPE, is a disregarded entity, a partnership, or a sole proprietorship, or an S corporation. And if you have a disregarded entity, or a sole proprietorship, or S corp, or a partnership, those are RPEs, and the partnership or the S corp themselves can make all sorts of elections and stuff. And so an RPE can look at its own rental real estate to try to use that safe harbor. And remember, the determination of whether something is a trade or business is done by each RPE with blinders on, looking only at what is within that RPE. The RPE does not look to any of the taxpayer's other activities, only what's done within the RPE. So you do need to find that at the RPE level that the real estate is a trade or business, and so it makes sense that the rental real estate enterprise would need to exist at the RPE level. Next slide. So now we get to the $64,000 question. What is an rental real estate enterprise? So it's an interest in real property held for the production of rents and may consist of an interest in a single property or interest in multiple properties. So the idea is that you are combining multiple properties potentially and finding that they are one single rental real estate enterprise. And then the taxpayer or RPE must hold each interest directly or through a disregarded entity. So going to slide 11, that will kind of go through this. So the idea is that, again, I said each RPE is going to put on blinders as to the taxpayer's other activities or what other RPEs are doing. And you may have a bunch of different real estate activities that are going on, and you would probably want, you're going to see in a moment, we have an hours threshold, and you would probably want to add together all of the hours from all of those activities when you apply the safe harbor. So the only way that you can do that is if everything is within the same RPE. So if you have separate different real estate properties and you want them to, you want to test them all together as part of the same RPE, what you would do is you would have a parent LLC typically, BV or a limited partnership, that a parent one, and they would own a bunch of LLCs that it wholly owns. So those LLCs that it's 100% owner of would be disregarded entity. So you would have a separate LLC for each property because you're going to want to do that for asset protection purposes. So they're going to be separately run for state law purposes, separate checking accounts, separate insurance, separate leases, all this kind of stuff. Everything will be separate for those subsidiaries, but they will all use the parent's tax ID as their own tax ID, and all of their activities are all added together, kind of smushed together, as if they were just one bunch of things that are going on inside of that parent RPE. So you really are going to need this to get the various hours tests, and we'll go through the hours test in a moment, and then without moving back to the slide, I'll come back to this idea. So let's go on to the next slide. So we're on slide 12 now. So what are some of the rules for creating a rental real estate enterprise? So a taxpayer can have more than one rental real estate enterprise. It would probably make the most sense because of various record-keeping requirements and hours requirements that you want to have everything done as one rental real estate enterprise. But the problem is that each interest, and you have to have similar rental property. And what do they mean by similar? What they mean is all commercial is considered to be similar, all commercial rental real estate, and all residential real estate is considered to be similar. So there's really only two types of property for this purpose: the commercial rental and the residential rental. And this idea that you're not mixing and matching the commercial and residential, the idea behind that is that those are really considered to be separate lines of business. They have separate industry codes when you look at the IRS's classification systems, and so this idea that commercial and residential are totally separate or are dissimilar is something that is kind of consistent with the other things IRS is doing in this area. So going on to slide 13. So generally, is that going to the next slide? I'm sorry, that was a different slide. Okay, sorry, I got confused there for a moment. So let me see what the difference was here. Oh, that was a duplicate. There we go. That's why it looked the same. Let's go on to slide 14. Sorry about that, folks. Okay, so once a taxpayer or RPE treats interests in similar enterprises as a single rental real estate enterprise, you have to continue to treat interest in all similar properties as including new properties as a single rental real estate enterprise. I don't really know any downside whatsoever to treating them as a single enterprise other than aggregation. So the issue is when you have aggregation, you have to have some sort of similarities between the properties, between the activities being or businesses being aggregated. So if you had, for example, real estate all over the country, and you had a business operation that was working only out of St. Louis, okay, then it may be easy to aggregate the St. Louis real estate with the St. Louis business because of various commonalities. But it may be difficult to aggregate the St. Louis business with the nationwide real estate. So the disadvantage of this election to treat them all as one is that it can make you dissimilar for aggregation purposes. Basically, I think what you're really going to want to do is, if you have activities that are closely tied in the real estate and they are just regular operating businesses, like a restaurant or a manufacturer or something like that, you're probably going to want to just have the real estate qualify under the safe harbor, not this safe harbor, but the automatic rule that I mentioned on an earlier slide, where I said that if you have related party rental, you automatically qualify as a business. So you're going to want to try to either have only local real estate to be aggregated with local businesses, or you might simply say, okay, I'm doing nationwide stuff, but I'm going to do something separate here, and I'm going to treat my St. Louis properties separately. So anyway, go to the regs, take a look, get it all figured out, and then if the other thing about aggregation is, about combining things into a single rental real estate enterprise. If you start combining it as a single enterprise, then you have to keep doing that forever. But if you start treating them as separate properties and not a combined single rental real estate enterprise, then you can later elect to combine them as a single enterprise. So again, this rule, having all these musts in here, is not so flexible. So let's go on to the next slide. Okay, so in the safe harbor, what if you have a single building that has residential and commercial use? So those are dissimilar, but you could treat them as a single rental enterprise if it's just in the same building. Or you could separate it and say, the ground level business tenants are one business, and the upper level apartments are another business. So you can separate them. And then the other thing is here each rental real estate enterprise that satisfies the safe harbor is treated as a separate business. All right, let's go on to slide 16. Okay, so each year you can decide whether to use the safe harbor. So just think about it for a moment. Suppose that you're stuck considering all of your commercial real estate as a single enterprise because that's what your election was. And you really want to aggregate. But adding all of those real estate together, it's not tied closely enough to your operating business. And so what you would really like to do is you would really like to just have the local real estate aggregated with the local business. So how would you do that? You might say, okay, I'm not going to use the safe harbor this year, so now I'm not treating it as a single business. And so now you would treat those real estate properties separately, and then those real estate properties would have to separately qualify as a business, either because of the self-rental rule or because you're doing a lot of work. So again, you can decide whether or not to use a safe harbor, but those elections you make might be irrevocable in terms of whenever you are using the safe harbor. Okay, so each rental real estate enterprise will be treated as a single trader business if you meet all of the following. First, you keep separate books and records for each rental real estate enterprise, and we're going to want to do that anyway. We're going to want to have a separate LLC for each property. When it comes to filling out your tax returns, you really need to separately list each property. That's the way that Schedule E Part 1 requires, and so you want to keep separate books and records for each rental real estate enterprise anyway. And by the way, if you have purportedly separate LLCs and that you want to try to say are separate, but then you keep one set of books for all of the LLCs, well then you've got piercing the corporate veil issues. So you're going to want to keep separate books and records no matter what anyway. Then also, so that's your first test, is separate books and records for each rental real estate enterprise. The second is that you need to have 250 or more hours of rental services each year. So each year that you've been in existence, or if you've existed at least 4 years, you can base it on 3 out of the last 5 years. And you also need to have contemporaneous records. And the contemporaneous record requirement is much stricter than the passive loss rules. So, for example, the passive loss rules will say, well, we'd like you to have separate, we'd like to have your contemporaneous records. It's going to get you further in terms of making it easier to prove, but you don't have to do it. You can go back and reconstruct it. Now, the tax court cases I've read, if you try to go back to reconstruct it, then it's pretty iffy whether you actually be able to reconstruct it. So I do recommend contemporaneous records anyway. But these contemporaneous records are, they are detailed on what you have to have. You have to do the hours of all services performed, description of all services performed, dates on which the services were performed, and who performed them. And also, if the services with respect to a rental real estate enterprise are performed by employees or independent contractors, the taxpayer may provide a description of the services provided by the employee or independent contractor, amount of time, and if you have, and the time and wage payments. And you have to have this available for the IRS. So this last part about talking about independent contractors and the record keeping for that type of things, that part was added to the notice. It wasn't in the original one. And also the other part of it is if the rental real estate enterprise contains more than one property, you can have income and expense information statements maintained and then consolidated. So that's an option there, and that's another thing that got added with the when they finalized the RevProc. Okay, let's go on to the next slide. So you have to attach a statement to a timely filed original return. So it cannot be an amended return. There was an exception for 2018, but the window for timely 2018 returns is done. So we don't really need to keep track of that anymore. The draft revenue procedure said that the statement has to be signed under penalties of perjury, and so you'd have to have it signed and attach a PDF and that type of thing. But if you think about it, the entire tax return is signed under penalties of perjury. So what's the point of having a separate statement with the penalties of perjury, separate signature there? So they dropped that requirement. The list of what qualifies and does not qualify as rental services is pretty much the same as it was before. And so is the list of rental real estate arrangements included from the safe harbor, other than expanding the reach of the triple net lease rule and the anti-service specified service trade or business exclusions. And I'm going to go over those now. So let's go on to slide 18. So it's interesting when people discuss what's a triple net lease. So there are some commonalities to what people think, and there's some differences to what people think. A commonality for a triple net lease is basically the tenant is assuming the economic burden of all the repairs and maintenance and stuff like that. And the triple net leases, generally commercial real estate, tends to be set up on a triple net lease. The idea is the landlord has invested in the rental property, and the landlord is getting a return on the value of his investment through the rental, and everything else is just kind of incidental. And so commercial tends to be that way, where the landlord will just have basic ownership expenses, and then each tenant has its own expenses. And then if you have like a shopping center or strip mall or something like that, then there will be some common expenses, and the landlord will take the common expenses and split those up, allocate them among the tenants. In fact, that's something that whenever people do leases, they look at to see, well, how do the expenses get split up among the various tenants? So they try to make sure that they're getting no more than their fair share. So usually in a triple net lease, you're going to have, in triple lease, you're always going to have, the tenant is going to be paying for everything. Then the question is, well, who's doing the work? Is the landlord doing the work, hiring everybody to come in to do the maintenance, hiring everybody to do the repairs, or is the tenant doing the work? So, like if you're in a shopping center, then you're probably going to have the landlord doing the work, because they're going to hire somebody to do the cleaning for everybody, because there'll be some economies of scale with that. So it wouldn't make sense for the tenants to hire when they can share in the economies of scale of having, a cleaning service that goes around and takes care of everybody. So you're going to have probably the landlord in some cases being more active with that. And the original safe harbor said that the landlord needed to be responsible for the maintenance activities for the property, in addition to the rent and utilities. And that's different than what we have now, because if you're responsible for it, that doesn't necessarily mean that you pay for it. I'm sorry, I kind of got this backwards. It was the tenant needs we were on the right slide. The tenant needs to pay for the maintenance activities. Need to be responsible for maintenance activities. So the idea might be that if the landlord, now I'm getting the whole thing backed up. All right, there was an idea under the original one that if the tenant paid for the maintenance, but the landlord arranged for it, then you might get out of being a triple net lease. But what it says here is that if the tenant pays for the maintenance, that's it. You don't look to see that the landlord is doing any work. It's a triple net lease. It is out of the safe harbor. So this is going to knock out most of your commercial real estate. Now let's go to the next slide. Okay, and so this is what I was trying to talk about, that the tenant had to pay for and arrange for the maintenance before in order for it to be triple net lease. And this clarifies that you just need to have the tenant pay for it. Then it's a triple net lease. Then it's an evil lease. It can't qualify for the safe harbor. Let's go on to the next slide. So again, this change will knock out most large shopping centers and large office buildings from the safe harbor because, again, the tenants are going to be paying the common area maintenance, and the landlords are not taking on that responsibility. But if you think about it, if you have a shopping center or a big office building, there's a lot of work involved and keeping track of everything that's going on there. So that's going to wind up being a trader business anyway. So I'm more concerned about they don't really need a safe harbor. I'm concerned about if you're somebody who has just one or two tenants, then you may be harder to take care of that to qualify as a business, and then that's when you need the safe harbor. But then that's also when you need the financial protection too of having a triple net lease. So I guess you have to be more entrepreneurial. The landlord is taking on more financial risk, then the IRS is going to let you get the safe harbor probably. So let's go on to slide 21. So here's another nasty thing the safe harbor does. And you may recall I mentioned earlier that if you have a specified service trader business, an evil business, and you are renting a part of your property to that evil business, then the rent for that part of the property becomes an evil business too. The rest of your rental is okay. The rest of your rental would not be considered to be an evil business. If you're renting it to third parties, they could even be evil business third parties, just as long as there's not related evil business. Just the related evil businesses that we're talking about here. So, in terms of whether the rental gets tainted as evil, that it's only the portion that's rented to the related party evil business. On the other hand, the safe harbor says that if any portion of the interest of the tenant is treated as an evil business, then the whole thing gets knocked out of the safe harbor. So again, the safe harbor is much stricter than the general rules. So let's go on to the next slide. So now that we've gone over the safe harbor, we realize the safe harbor basically does almost nothing for you. And I can't really think of any particular times that I would ever really care to rely on the safe harbor because it just ties your hands too much. So when is rental a trader business? Well, we had an earlier slide what the preamble was saying in terms of the ideas that you might look at, the factors you might look at. But it's really a matter of case law. As I mentioned before in my earlier webinars, it's again like the Supreme Court's definition of pornography. You know it when you see it. And I do have a few bullet points here of places where you can go to look at whether rental is a trade or business. And the first part, that part 2I8C Romanet 3, rental is a trade or business, that is my discussion for net investment income tax. So if you recall, net investment income tax it applies to all passive activities. Rental is per se passive. Generally, it kind of knocks out the per se, but there's an exception. There's exceptions for self-rental, and of course we already have a self-rental here to take care of us. But there's also an exception for a real estate professional who spends most of his time and spends a lot of time working in rental that's a trade or business. And so for that real estate professional exception, you have to know what a real estate trade or business is. So I compiled in there, when does rental rise up to the point of being a trade or business? So that's the primary discussion. The next one in 2G4 relates to basically, is this a business in terms of being for profit versus being like a hobby or something like that. So generally, that's not going to be as informative as the first bullet point, but it still does have some points about carrying on business regularly and continually and stuff like that. So you can look at that as well. And then real estate as a trade or business. One of the ideas here is that rental, that you could be a dealer, and if you're a dealer, then you don't get capital gain treatment when you sell your property. So you would, you don't want to be a dealer, of course, but it does have some general ideas about when real estate is a business. So you might want to look there too. So if you kind of narrow down, just kind of big picture. So one rental to one tenant can still qualify as a trade or business if the landlord does enough activity. So the safe. I don't think the landlord needs to spend 250 hours either. So I think the safe harbor is much more stringent than case law. But the safe harbor does talk about records that the IRS wants you to keep for the safe harbor. And like I said, those are pretty stringent rules. But if you satisfy the stringent rules of the safe harbor, then I think those will help you generally qualify for the business, the trade or business. So even though you might say, I'm not going to mess with the safe harbor, it would still be good to try to document your work to as if you were trying to qualify for the safe harbor, so you can have just the best evidence possible when you go on with IRS. Okay, next slide. So then the question is, should the landlord do more work so the landlord can get the QBI deduction? So you can see I have various questions here about whether you want to get you need your W-2 wages possibly to get your 199A deduction. So, and this is all about getting your 20% deduction for that. So if the landlord has the landlord's own employees, then that will help the landlord with the W-2 wage calculation. Now, of course, some landlords, it doesn't make any sense at all for them. So you have somebody, they just invested in real estate, and then it's just a passively owned investment. They don't want the liability. They don't want the hassle. Forget the 20% deduction. We're just going to do things the easy way and not mess with all these hoops. Okay, next slide. All right, that is it for that. I don't have any questions yet, so please go ahead and submit your questions if you want to. I'm going to go in and talk about partnership structuring. Now, These are different, totally different topics, but they all are just kind of within general theme. None of them is worth a ton of discussion, but they're worth at least just touching on a little bit. So we'll talk about employee versus partner and tier structures. We'll talk about interest expense and interest tracing. We'll talk about basis step-up opportunities. So let's go on to the next slide. So when it comes to employee versus partner and tier structures, we're going to talk about regulations that got finalized just this past year. And we'll talk about what those cover and what those don't cover. Next slide. So all of a partnership's or sole proprietorship's operating income is subject to income tax and self-employment tax. Of course, not if it's long-term real estate rental, but those are exceptions. But the general rule is if it's a trade or business, then you're going to have self-employment tax. So the next thing to point out is that if you have payments from a partnership to a partner, maybe you're paying the partner $10,000 a month to do their work, or double that, or triple that, or whatever. So that really is like a salary. It is never correct for a partnership to report payments to a partner under Form W-2. Instead, they're reported on the Form K-1, generally as a guaranteed payment under 707C if they're done in the capacity as a partner. And if they're done as an independent contractor, well, of course, that's really not, that probably would be W-2'd anyway, but that would be Code Section 707A. So anyway, you're never going to report payments to a partner on a W-2. Some people really love to do this. When the IRS sees it, as long as all the employment taxes are being paid, a lot of times they won't get all excited and they won't audit. But it can make a difference, and in terms of other aspects, like you like to have more W-2 income to get a better deduction under Code Section 199A. And the fact is that when you're a partner in a partnership, you can't do that. You can't count your compensation to the partners as W-2 wages to get your QBI deduction. So some people will go to some lengths to double check. They do want to get a W-2, or they like the withholding ID instead. So let's go on to the next slide. So the final reg said that an entity that is disregarded for income tax purposes is also disregarded for self-employment tax purposes, even though it's a separate entity for payroll tax purposes. So let's suppose we have parent and subsidiary, and subsidiary is a disregarded entity. So when the parent, when somebody works for the subsidiary disregarded entity, the subsidiary is going to issue the W-2. So even though the subsidiary is going to issue the W-2, because the subsidiary is a disregarded entity, you're going to be looking to the parent status to determine whether the subsidiary can issue a W-2 or has to list it on a K-1. So a partner in a partnership that owns a disregarded entity is treated as a partner with respect to the disregarded entity and cannot receive a W-2. So I call that the DRE rule. Next slide. Now, what about tiered structures? So what if you have a parent that has a subsidiary, but instead of being 100% owned subsidiary, the parent owns 80%. So it's not a wholly owned subsidiary, but you control it. You own so much of it. You're really running everything. So it really is kind of like a subsidiary. If you were thinking about like corporations and an affiliate group, you would call that a subsidiary because it's controlled so much. So what happens then is that subsidiary does not necessarily have to look to whether it's the person is paying is a partner in the parent. Instead, the subsidiary will look to its relationship with that partner. So, go on to the next slide. Let's suppose that Partnership P, the parent, owns 95% of Partnership S, the subsidiary, and A is an individual who owns the other 5% of the subsidiary partnership, Partnership S. Well, if A is a partner in Partnership S, then A cannot be an employee of Partnership S because A is a partner in Partnership S. Okay, so A is a partner in the subsidiary, so cannot receive a W-2 from the subsidiary. However, A is not a partner in the parent under this fact scenario. I mean, they could be, but in this fact scenario, we're just supposing that A is not a partner in Partnership P. So A could be an employee of Partnership P. So the idea is, if you have the subsidiary and you give an employee a profits interest, then they become a partner, and then you can't pay them on a W-2, but the parent could pay them on a W-2. Let's go on to the next slide. Go on to slide 30. So this may be a way around it, but let's just put a skeptical hat on. If A works exclusively for Partnership S, and Partnership P were merely the nominal employer, so the parent employs A, and the parent leases A to the subsidiary. Well, if all A did is work exclusively for Partnership S, there's really no reason for A to be on the parent's payroll. Potentially, at least the IRS might argue, and the IRS might argue that Partnership S is considered to be the true payer of the compensation. So then A can't get a W-2, and this is not exactly right on point, but there was a chief counsel advice that I cited there, and you had a partner, and the employer hired the Certified Professional Employer Organization, and basically the chief counsel advice said that the CPEO couldn't give a W-2 to the partner because he's a partner. You can't get a W-2. So instead, the CPEO had to issue a Form 1099 to report that compensation, and that was a 1099 miss. And it's interesting because since then there's a new 1099 form for non-employee compensation, and I'm not going to cover that, but I just wanted to alert you to it. Okay, on to slide 31. That's it for that issue. So interest expense. We're going to talk about how to determine the deductibility of interest expense. We're going to talk about how distributions from a partnership affect that determination, and then a case that the taxpayer recently won when the partnerships changed hands. Next slide. So generally, interest expense is classified as business, investment, or personal. And this came in with the Tax Reform Act of 1986. It was tax simplification. Therefore, they created more categories of things to keep track of, because that's how you make things simple, by having more categories. So what the Tax Reform Act of 86 said was that borrowed funds, you look to see what they were used for, and then you will treat the interest expense accordingly. So if all the proceeds went for a business purpose, a business use, then you treat it as business interest. If it was all went through to buy stocks, then it would be investment purpose. Going back, and then if the loan proceeds, instead of going, if they could be used, there's two ways you get the loan proceeds. So one is the borrower could get the money and then use them to buy the asset. And there's some very helpful conventions in the regulations under Code Section 163. You can see up there, there's this Rome numeral 2G21A that, that I've got details there. So if it goes directly to the borrower, you trace the flow of funds to see what the borrower did with them. So if they had the borrower's checking account and within a certain amount of time, I don't remember whether it's 30, 60, or 90 days, but within a certain amount of time the borrower spends them, the borrower can elect to trace them to whatever expenditures he made within that period of time. Next slide. If the lender pays directly pays the seller of the property or whatever person is receiving that money, then we treat the debt as if the borrower used the proceeds directly for that expenditure. And then, if a taxpayer incurs or assumes a debt for the sale or use of property, services, or any other purpose, or the taxpayer takes property subject to the debt, then the debt is treated as if the taxpayer paid for the property, services, or other purpose. Next slide. So there's a couple of notices in 88 and 89 that talked about what happens when you have debt finance distributions. So generally what you do is, in other words, a partnership is borrowing money. It might be using some of that internally, and in that case, the tracing, you look at the tracing rules and that type of thing to determine that character. But to the extent that it actually gets distributed out to the partners, each partner has to separately account for how that partner used those proceeds. And then the partner would then would then deduct or not deduct the interest based on the character of that interest. So you're going to separately trace each partner's use of the proceeds of the debt finance distribution and allocate interest expense to each partner as we discussed. So next slide. So here's a case called Lipnick, and Dad used debt finance distributions to buy investments, so the interest expense was what's called investment expense. So when you have investment interest expense, you can deduct that only to the extent of your net investment income. Now, net investment income for this purpose is totally different than the net investment income tax. So don't even think of those two ideas. So investment interest is basically interest incurred to buy investments, and investments tend to be stocks or taxable bonds. Or it could be other property that you're holding in order to generate taxable income. So, in this case, Dad had investment interest, so he took the loan proceeds and he used those to buy investments. So, so the IRS said, hey, Dad's use of this will determine the use of the debt forever. Now, in this case, Dad gave and bequeathed partnership interests to the son while the debt was still outstanding. So what happened is that the son took the property and was deemed to take it subject to debt. Let's go on to the next slide. But we know the assumption of debt is like a payment. If I assume your debt, then it's just like I paid you for whatever it was that induced me to assume your debt. So so what happens is, anytime you have a partnership interest that gets transferred, if there's any debt outstanding, then that debt is deemed to be a sale. I mean, it could be a bargain sale. There may or may not be any gain or loss on a sale, but it is still deemed to be a bargain sale. And so you essentially were having a sale of the partnership interest, and the new partner, the son, is deemed to have bought that property assuming that debt, or bought the partnership interest assuming that debt. And the debt was allocated among the partnership's properties, which did not please the IRS, because son would get a business interest deduction as opposed to investment interest deduction. So next slide. All right, so that takes care of that issue. So now we're going to talk about how basis adjustments flow inside of tiered partnerships. So you may have different layers of ownership of a partnership, and you may have sales of the ownership interest in the parent entity. So let's talk about how basis adjustments flow inside of tiered partnerships. So can you, if you have an outside basis step up, a basis step up in your partnership interest itself, or another example would be your increase in the basis in your stock if you're a corporation. So anyway, I lost my train of thought. We'll go on to this next slide here. If the upper tier partnership, so the parent, has a Code Section 754 election in place, then a qualifying transfer would cause a basis increase in that parent, that upper tier partnership's assets. And one of those assets would be its basis in the partnership interest in its subsidiaries. So its basis in partnership LTP being lower tier partnership, meaning subsidiary. So the partnership interest in the subsidiary would increase. But the question is, what about the basis of the lower tier partnership's assets? Well, that just because the basis in your partnership interest increases doesn't necessarily mean the basis in the underlying assets will increase. You need to have a 754 election in place. So even if the upper tier partnership has a 754 election in place, what you really want to do is have a 754 election in place in all the subsidiaries at each level, so that the basis step up can pass through to the assets inside of those lower tier partnerships. Next slide. Okay, so and here's a letter ruling 2019 where the partnership basically had an increase in basis, and it was treated as an aggregate of its owners under the anti-turning rules, and apply those to the transfer intangibles to decide whether they got to be amortized or not. And we're going to talk about intangibles as well. But I think the point is that that rule is still alive and good, that you need to have the 754 election at each level. Next slide. Now, what happens if you have a net unrealized loss inside the partnership? If you have one of these triggering transfers, then they will trigger a decrease, a basis step down in the partnership share, in the partner share of the partnership assets, even if the Code Section 754 election is not in place. This came in with some 2004 tax law changes. So then the question is, what kind of transfer is going to trigger this basis step down. So a qualified transfer includes an exchange, whether or not the exchange is taxable. Next slide. In this TAM, there was what's called an assets over merger of two partnerships. Partnership X was deemed to contribute all its assets and liabilities to Partnership Y in exchange for an interest in Y. And immediately thereafter, X was deemed to distribute its interest in Y to X's owners in the liquidation of X. So basically, X was deemed to liquidate, and so you had Y. It was remaining. So that was a non-taxable transfer. Next slide. But it was considered to be an exchange, and the TAM said that a qualified transfer includes an actual or a deemed distribution of the partnership interest, and the TAM used that to get a mandatory basis step down. But you can also imagine there are times when you have a basis step up that you would like to pass through to the entity. Maybe the 754 election was not in place in a timely manner. Maybe you need to take some steps to get that 754 election in place and get the outside basis applied to the assets inside the partnership. And so when that happens, you need to have some kind of a sale or exchange of the partnership interest. And the issue, the kind of the illustration, the whole point of this is that you can have exchanges that are non-taxable events. And I've already mentioned in my materials before that when you form a partnership or you form an S corporation, those are exchanges that qualify. And so this now points out that you have other types of exchanges that qualify that don't necessarily trigger any tax. So that can be favorable to you, that you're wanting to apply this outside basis, but you didn't have a chance to do that before because the 754 election was not in place and you missed your deadline and everything. So now here's a triggering event that can let you need to go and make sure that 754 election is on. Okay, next slide. Now we're going to change horses and talk about intellectual property. I still don't have any questions, and the chat box is still open there if anybody wants to ask questions. So, intellectual property. We're going to talk about how the 2017 tax law changes curtailed favorable treatment on the sale of intellectual property. And we'll also talk a little bit about how goodwill differs from intellectual property. So, let's go on to the next slide. So, a really weird thing in our tax laws is that property used in a business is not considered to be a capital asset, even if it requires a lot of capital investment. So you buy a building to use it in your business, that is not a capital asset. So Code Section 1231 treats as capital gain any gain from the sale of business assets, except to the extent of depreciation recapture. So the bottom line is that you can get capital gain treatment on this asset that's not a capital asset, even though it's not a capital asset. So Code Section 1231 is kind of magical in this respect. The other magic of 1231 is if you have a business asset and you have a loss on it, you get to count that as an ordinary loss. So now we are in taxpayer nirvana because the taxpayer is getting capital gain treatment on gain and ordinary loss on losses. However, if you take an ordinary loss in 1 year and then in a later year you have a 1231 gain, then you have to what we do call recapture that ordinary loss. So that ordinary loss will change the nature of the gain to ordinary income because it's basically trying to make it even. They don't want you to play games and have all capital gains and all ordinary losses. If it's all the same type of property, all business property, then you want to kind of treat them the same. And so this idea of recapturing the prior losses comes into play. Next slide. So what's ineligible for 1231? Inventory, property held for sale to customers in the ordinary course of a trade or business. And I'm not quite sure how that differs from inventory, but it's another category. The last bullet point was certain U.S. government publications, but look at the third bullet point. A copyright, literary, musical, or artistic composition, a letter or memorandum, or similar property held by a taxpayer described in Code Section 1221A3. Now let's go to the next slide and see what that code section is. So Code Section 1221A3 excludes from capital gain and Code Section 1231 treatment a patent, invention, model, or design, secret formula, process, etc. A taxpayer, if they are held by a taxpayer whose personal efforts created such property, or you can see, or it could be this, you might have commissioned somebody to write that for you. So kind of the bottom line is that this kind of originated, and it's either the original taxpayer or a carryover basis or something like that. But the bottom line is that if it's a self-created intellectual property, then you're going to have ordinary income on that. So think about, I guess the question would be, well, why would they do that? So let's suppose that you're in a business and you pay and you decide to sink $100,000 into a patent. And what you do is you're paying an outside lawyer that $100,000. So you've already done your R&D and stuff like that, already deducted that, but you pay the outside lawyer for the patent. So when you pay the outside lawyer, you're going to get an ordinary deduction for that, ordinary loss. But when you sell the patent, you'd have capital gain treatment. Well, that wouldn't really be too fair to the government to, you pay $100,000 to the lawyer, you get $100,000 ordinary deduction, and then when you sell it for $100,000, which is really essentially no gain or loss, you have $100,000 capital gain. So now you have this, the best of all worlds, the purified, capital gain, and the ordinary deduction for when you put the money into it. So they basically, Congress says no. You have to, if you're going to be writing off all your expenses for any self-created intellectual property, so you should treat those as ordinary assets as well, since they're generated by ordinary expenses. Okay, let's go to the next slide. There is a way around this, and you could use a partnership. Now, before I mention this, I want to say that there are partnership anti-abuse rules, and if you did a partnership just for this purpose, then you might get caught up in those anti-abuse rules. So I'm really kind of more thinking about what happens if you have this property inside partnership and you sell the partnership. Well, if it's self-created goodwill and therefore it's not being amortized, or any intellectual property, and it's not being amortized, then when you sell your partnership interest, you'll get capital gain treatment for that. Now, if you are amortizing it, then you still can get capital gain treatment if you're using a Code Section 736 redemption, and that type of redemption is a total liquidation of the partnership interest. So you're being totally bought out of your partnership interest. So if you're in either case, either it's not being amortized or it's being amortized but it's in a 736 redemption, then you're basically, all of your gain on that is kind of wrapped up in the partnership interest itself, and you can pay capital gain tax on that. So keeping the intellectual property inside of a partnership and sounds like a good idea compared to being standalone. All right, let's go on to the next slide, 49. So purchase goodwill and other intangibles may be amortized unless these anti-churning rules apply, and that has to do with property that was around in 1991. So if it's before 1991, then they don't want to let you amortize it. So there's these so-called goodwill anti-churning rules. Next slide. So the letter ruling I mentioned before about the tiered partnership getting an inside basis adjustment when it had a 754 election in place, that ruling also described how the IRS would treat various transactions under the goodwill anti-churning rules. And now the kind of the downside is that, and I kind of hinted at this a little bit earlier, goodwill amortization provides current deduction, but it may cause the goodwill to be subjected to ordinary income tax instead of capital gain. So let's look on the next slide. Consider what happens if you amortize X dollars and it grows in value to 10X. So you bought a business, $1 million of that got allocated to goodwill, you amortize that, you wrote off the full $1 million. Now this property has grown to $10 million, and because you have amortized it, the whole property gets subjected to ordinary income tax instead of capital gain. So to me, that's a really steep price that you really need to think about. Now you might even go to some extra record keeping work to try to say, well, I have two goodwill assets, one that I bought, one that I developed, and they're different. So if they are different, I remember where I was going to go with that. All right. So the kind of the idea is that if you have this $10 million assets now it's tainted by ordinary income tax, that $1 million in deductions, you really would have wished you never took it, because I'd rather have $10 million of capital gains than have $1 million of ordinary income, of ordinary deductions, and $10 million of ordinary income when it gets sold. All right, so also let's think about self-created intangibles. So if you have self-created intellectual property, then that doesn't get the capital gain treatment. But if you have self-created goodwill or other intangibles, it does get capital gain treatment. So if you are going to be selling a business, you may want to separate out the intellectual property from the goodwill, and when you are analyzing it, you might try to take a view, well, let's view as goodwill as much as we reasonably can so that we can get the capital gain treatment. Okay, then a sale of intangibles between related parties may trigger ordinary income tax, and there are special related parties rules for partnerships and also for S corporations. Okay, next slide. All right, I do have some questions, and I am going to get into those questions, but before I do that, I want to mention some resources for you. So first of all, as always, you can go back and look at my fiduciary income tax refresher and my blog and heckling reports. And my fourth quarter newsletter is going to be on January 28th. And then I have a couple of Lineberg webinars coming up on Thursday. I'm going to be doing one on basis step-up strategies for equipment and real estate. And also, we have something hot off the presses. So Friday night, the transfer for value regulations were released by the IRS, and a draft of them was published on the Federal Register webpage. And Thursday morning, the final version of those is going to be published on it. Right now, I'm working on updating my materials on the final regs, and I'm going to get them in, and I'm going to get them all worked in, and then Thursday morning when the final come out, I'm going to do last second tweaks, and then I am going to be recording a webinar for an hour and a half, going through in detail the transfer for value regulations, and these transfer for value regulations say that if you are transferring life insurance and you're selling the life insurance policy, then when does that taint the policy so that the life insurance death benefit would be subject to ordinary income tax? So I'm going to be recording an in-depth webinar for an hour and a half. That's going to be shown on Wednesday, November 6th. And if you go to Lineberg Webinar Services, you will see that registration for that is posted. Now, for those of you who can wait and just want to get a lighter touch on this, I will cover this in my fourth quarter webinar on January 28th for free. The Lineberg one costs money, and it's an hour and a half. My webinar in January, I do 3 topics, so you're going to get roughly half an hour of coverage on it for free. So you have your choices on what to do for those. All right, so questions we have here. You want to just go ahead and read the questions, Irene, since it looks like it's not. Aha, there they are. Okay, you want to just click on the first one? Do the 1252 one at the bottom. Okay, if individual member owns parent LLC, but there's a disregarded LLC subsidiary owned by the parent, then can the individual member work for the subsidiary as an employee and earn salary? No, because the individual member is a partner in the parent, and the subsidiary is disregarded. If the subsidiary were its own partnership, so maybe it was an 80% owned subsidiary, then you could have the member work for the LLC. Well, you have to have them work for the parent. So the answer is no. If a person is a partner in a parent partnership and works for either the parent or any disregarded entity, then that person is a partner, no ifs, ands, and buts, and does not get a W-2. So that's the answer to that question. Let's go on to the next question. Yep, right next to it. If goodwill is subjected to ordinary income tax, can it be included in qualified business income? And the answer is yes. It is eligible for the 20% deduction, but remember, if your taxable income is above threshold, you have to have enough W-2 and UBIA to be able to take the deduction. So if you're selling your business and you have a whole bunch of income there, you might not have enough wages in UBIA to be able to take the deduction. So it's included in qualified business income, but you may get little or no deduction for it because of the W-2 and UBIA limitations. So let's go on to the next question. So purchase goodwill will always be subject to ordinary income tax. And the answer to that is yes, it will, because you've amortized it. And so it's considered to be what we call a hot asset. So goodwill being used in business is not a business asset. I'm sorry. Goodwill would be a business asset, but it would be kind of knocked out of 1239 if it's purchased goodwill. Okay, let's go on to the next question. And the question, when it's sold is when we will be testing that. Okay, next question. What if previous employee was granted a bonus to buy into the partnership? However, he set up a partnership with his wife to own the interest, not a disregarded entity. May he still receive a W-2 from the employer partnership? Okay, so go back up a little bit. Okay, so we have partnership, and then husband and wife own an intermediate entity. So then he is a partner in that intermediary employer. He's a partner in the intermediary. He's not a partner directly in the partnership. So I do think that you may be able to count them as getting a W-2 from the top tier partnership. I'm thinking the answer is yes, but I haven't done the full analysis on it. So I'll give you a tentative yes, but my answer is you really need to kind of go through and look at that preamble language and at the Revenue Ruling 69-184 and anything that cites it. But I am considering leaning favorably toward that W-2 there. Okay, do we have any other questions? Okay, we have no other questions. Let me think if there's anything more I want to go back and spend a little bit more time on. Okay. I did enough with the partnership interest. I'm kind of having second thoughts on the amortized goodwill question, because when I'm looking back at 1231C1, and that was on a prior slide. Let's go back several slides. Can you get to that?
2 slides, sure.
All right, keep on going back. One more. Okay, so one more. Okay, so here's the 1231C exclusions, and so the literal language is property of a kind which would properly be includable in inventory of the taxpayer if on hand at the close of the taxable year. Well, that wouldn't be the amortized goodwill. Property held by a taxpayer primarily for sale customers in the ordinary course of trade or business, that would not be goodwill. So copyright, literary, musical, or artistic composition, or letter or memorandum, or similar property held by a taxpayer described in 1221A3. That does not appear to be that. and government publication. That's definitely not that. So it may be capital gain for the amortized goodwill. I just don't come across amortized goodwill all that often. So I may take that back. I think we might get capital gain treatment. So I'm going to have to say that just will require more research. So I'm not going to be definite on that. Okay. Anything else that's popped up since then? Nope. Okay. Well, I'm just going to give it a wrap then. And I've kept you over before, and this time I'm giving you less time. So enjoy the rest of your day. And I look forward to talking to you with my January webinar, if not before. Thank you very much. And we do have evaluations, so please complete and submit the survey located in the widget that's at the bottom of your screen. Thank you very much.